This is Mitch, and welcome to the 1000houses.com podcast. I'm here with Scott Meyers, and he's been around for a long time helping people understand and take advantage of the cash flow that can be had from self-storage business or the storage business. I am a big fan of the storage business. It's really what I know retires me at the end of the day. I don't have to do anything if I don't want to, because I have, over 1,000 units myself. Just paid them off, Scott. Have no debt.
Congratulations. That is a great place to be.
When 1,000 people owe you about $125 a month average, and you don't have any debt, it's a good place to be, man. It's a good place to be. It took me way too long, though, and I should be further along. I should have 2,000 or 3,000 units, but I just did it all by the seat of my pants and kind of on my own. And as I would clear time for it, because my main thing was I was buying and selling a lot of houses, and I never really paid attention to the storage business until I looked up one day and said, at my tax return, and said, holy crap, what's this line go to? And they said, it's your storage business. And I said, well, there you go. So tell us, you're in Indianapolis, right?
That is correct.
All right, give us a little background, Scott, and then let's talk about the storage business.
Let's do that. Yeah. So the story begins in real estate with single family houses as well. I think that's how most people get into real estate to begin with. And using the old Carlton Sheets method and his home study system back in 1993, bought my first single family house, rehabbed it, refinanced it, rented it out. And we took the proceeds from the refinance and went and bought two more. And then it just continued on after that until we had about 80 houses, and decided that, I don't have the cash flow and the free time like Carlton Sheets talked about. And so I got to be doing this thing a little bit differently. And so let's double down and go into apartments, and figured economies of scale would fix that. So we started buying apartments and had about 400 apartment units and a few small complexes around central Indiana, and realized that wasn't working for us either. Even if we had property managers and property management companies, we still, at the end of the day, it's a labor intensive business when you're in the tenant toilet business, and the buck still stops with you, and we still have to write the checks, and the bigger problems usually still land on my desk. And so we decided that, if I love real estate for all the reasons you just mentioned, especially come tax time. I mean, we can depreciate these things, they appreciate, we can force appreciation in real estate, and we can borrow money to buy them. And then we put renters in our units, whether they're apartments or houses or self-storage, to pay down our basis. There's no better investment on the planet, bar none, period, if it weren't for the tenants and toilets and trash and the houses that go along with them. And so when I looked around the landscape, that left the real estate landscape, that left parking lots and self-storage. And so there's not a lot of value that you can create in parking lots, although they're a good business for some folks. But what really got me intrigued was self-storage, because you can do all those same types of things and force depreciation and value and improve them and increase rents. But you don't have all the hassles and the challenges and the time that goes along with managing people. And so that's when I began looking into the business. And there wasn't a whole lot of resources at the time. There was the trade shows and associations that you could go to, and the magazines. But that was a lot of training for existing owners and folks that are already in the business and managers. And so I went to the trade shows, learned as much as I could from mostly the attendees, just asking the questions and, making buddies with the guy sitting next to me or the gal sitting across from me at the round tables, and just asking them about the business, and got into the business, did very well. And then as I ran my real estate investor association here in Indianapolis, people started asking, how I was doing this. And so we started holding workshops and teaching people how to get into the self-storage business. And my second business in self-storage was born, and that was teaching people and educating people on how to find, evaluate, purchase, and manage self-storage facilities. And so, through the years, we continue to invest heavily in self-storage, and our education business took off because we were the only game in town, people, really revealing the secrets on it. And before I knew it, Mitch, and this is about the time you and I met, I had two 60-hour-a-week businesses, and decided that was unsustainable. So we started to combine the two and peel back my hours in both, but then really merge them with, working with folks that were wanting to get into the business, but then also having an opportunity to partner with them to raise capital and syndicate and do joint ventures. And that's where we found ourselves now. And so now that we we're doing this less time in both businesses, doing better deals with better educated investors and joint venture partners, our business has just exploded. So we're up over 2.6 million square feet now, and we're approaching 15,000 doors nationwide. And COVID 2020 and 2021 have been our best years, and they were the best years in the industry and storage. And 2022 is off to a bang. And so we're absolutely looking forward to what the balance of this year is going to hold for us.
Okay, so there's a lot to talk about in this business. I started out, maybe, I don't know if you're a proponent of the way I started out or you'd rather do it a different way. Let's talk about that. I mean, I started out at Canyon Lake, Texas, and found that I could actually buy these mom and pops that they weren't so expensive. I mean, granted, my first unit was 15 little boat stalls in front of Comel Park, the entrance to this park where people would grab their fishing boat and go fishing. And so I would store 15 fishing boats, and I paid $8,000 for it. And they were I got the rents up to $45 or $50 a month a piece. And it only took like 14 months to pay back my credit card because I didn't have any damn money. So I just bought them with my credit card, $8,000. And then I took the money and sent it all to my credit card till it was paid off. It took about a year and a half. And then I owned it free and clear. And then I know it. I started thinking, wow, this is a lot different than rent houses. You know, these happen to have a dirt floor and chicken wire dividers and rusted corrugated aluminum panels. But the money was just as green as any money I ever collected. And I noticed one thing. These people might lose their houses, but they'll be dead before they give up a boat.
Yep. You got it.
They'll be dead before they give up their boat. So then I just started buying the little mom and pops, 25 units here, 35 units, whenever I could. And fortunately, the mom and pops would sell or finance me the property if they'd ever sit down and talk to me at all. And I ended up buying 18 little facilities around the lake and started to have, although I didn't have a lot of units, I started to have a big reach. Like people would call me from one place and I go, well, I'm full there, but you don't really, where are you coming from? They said, well, I'm coming from this place. I'd say, well, you don't really want to be here anyways. You want to be over by your house, don't you? And I don't know, then functional obsolescence started setting in, right? The boats weren't little John boats anymore. They were, had speakers and racks and all this stuff. And I had to tear down some and rebuild some, but I didn't have any money in this land. So that's how I got in it. But how do you suggest people start in the business?
Well, certainly there's no judgment here, Mitch. You've done extremely well, and it worked out for you. So no matter how you get into it, certainly many of the folks that come to us, they don't know what they don't know. And so, yeah, they get themselves educated first to avoid, any mistakes. I mean, in commercial real estate, if you make a mistake in underwriting by $1,000, it's really, about $10,000 in value you may have left on the table. Or if you don't know how to create value, then you may be leaving 10,000, 100,000 in value just because of what you don't know. And so, we always suggest that people, understand the asset class and the nuances of it, how to make money, how to not lose money, and how to reduce your expenses and how to increase income. But not to the point where, you have to know everything and be an expert before you begin the business. I mean, you have to have a basic understanding, get some good folks alongside of you, have good mentors, good consultants, and, even the lenders along the way, they assist to a point, but surround yourself with a good team to make sure that you have dotted your I's and crossed your T's before you get into it. But ultimately, there's just no, substitute for good education. And as you and I both know, and teaching people over the years, there's several folks that you're going to get educated one way or another. And many folks have heard this, either you get educated on the front end or the market's going to educate you. And many times that's much more expensive than, paying for the consultants, paying for the mentors, and, just making sure that you go to the events, go to the, trade shows and learn about the business before you just get into it, and assuming that, because self-storage is the best asset class and it's been the most profitable, that, you have this big wind in your back in the sale that you put up, that it's always going to be great, because it is until it isn't. And then when it isn't, that is not the place where you want to be. So
you can screw up anything. You can screw up anything.
Because it's all business, and people treat many businesses like a hobby, and there's no business that's a set it and forget it. You have to walk the four corners of your business, and you have to also shine light in the dark corners to understand what's going on. And so, yeah, you have to mind the store.
Yeah. So choosing partners, I mean, no matter really the storage business or any business, let's talk about that for a second, because who you decide to team up with is ultimately going to be the death of you or the victory, because the business can only be as good as the partner that you pick. And so how do you, I mean, I know how I vet partners, and we could talk about it, but how do you suggest choosing a partner in this business?
Well, I've seen the way that some folks have done it, and it hasn't worked for them. And that is that two broke people with bad credit get together, and because they have a love for real estate and decide to go into business together, and neither one of them benefits the partnership, and they either never get off the ground, or neither one of them has a strong suit, and the business fails, and if they happen to get into it to begin with. So the best partnerships, at least for us, is also, Mitch, the same in the way that we hire staff. And that is that, we have our core values and our mission statement pretty well dialed in, and we live by it. It's not just some plaque that we put on, or just something that we revisit once a year in our staff meeting. We go over it on a regular basis. My staff members can recite it. And if you don't share our core values, and if you can't buy into the mission statement, then you're not going to work for us, and you're not going to work with us. And certainly, I'm not going to get into a partnership with somebody who's not living that out. And so we need to understand that there's a certain level of integrity. Most people know me and my faith, and I wear it on my sleeve, and I'm not ashamed to share, and also not share with a potential partner to say, hey, this is how we're going to operate, and this is what I believe in. And you don't have to believe the same thing, but if I see that you're going out and doing the opposite of what we believe in, which is, not living by a code, and that code is pointed north, then, we're probably not going to do business together. So I think you need to really get to know the person that you're going to be partners with, because it is, as everybody says it, and it is true. It's not a cliche. It's like a marriage, and it certainly is as ugly as a divorce if a partnership goes bad, if not worse, because there's more dollars at play usually, and a lot more at risk, essentially. So that it starts there. But then really, when it gets down to the brass tacks, it's who brings what to the partnership. And if your partner doesn't bring a strong suit, or has something mastered that is completely your blind spot, or a deficiency in your business, or in your in your business to begin with, then do they really help you? And are you really helping each other? Or are you just two people that are trying to go at the same speed, but you're going to be stuck because you still have a deficiency in some area of the business? So if you're bringing in somebody who's got a strong balance sheet because you don't, even though you've got the cash, but they don't have the cash, and they bring the balance sheet, and they've got development experience where you've got the operations experience, when you begin to put the pieces together, as the movie says, you complete me. The partners should complete the business and complement each other. So that's, I think, to paint a broad brush stroke, be aligned morally, ethically, and making sure that it is somebody that shares your core values, and then they bring something to the partnership that you don't already have.
Yeah, I think that's a whole mouthful right there. I mean, in some cases, in some businesses, like the house flipping business, you can partner with a person one house at a time, and when it's no fun, or you figure out that this isn't working, you can stop and you just don't do any more houses together. And those deals are, you're in and you're out, and you're in and you're out, and you decide not to get back in again when you see that you have differences. And but in some bigger deals, you don't have that luxury, right? You're either going in or you're not, and so you really need to do your due diligence. And today it's not that hard to find out a lot about people. Really.
No.
I'm always interested in how litigious they are. I'm always interested in criminal history and credit. Not because people that have bad credit are bad people, but I just need to make sure that whatever the debacle was, or that it's over. You know what I mean? The debacle is over.
And how did they handle themselves through it as well? Because when things go bad, that's where you find out that folks' true character. And so we'll dive into that. And I've got a couple of partners that have gone through bankruptcy, and heck, you've been at this business for 3 recessions. Then chances are you probably come close to it, or had a bankruptcy even in an LLC. But I want to know how they handled that. Talk me through it, and if I can sense from their story that they handled it with integrity, and hey, I put all my money in to try to save the thing as much as I can. Or if they just said, the minute things were going south, I wiped my hands and all my investors lost their money, but I wasn't going to lose any of my retirement or savings to try to save it. I walked away. Well, there's a difference in how you handle those. And if you can discern, that this is somebody that's going to go to bat for the deal, then that's somebody that you want to make sure that, you keep close. And the others, if they're just walking away from their problems, then that's somebody you probably don't want to do business with.
Yeah. I have I guess on the first, I'll pay payments on $26 million to private lenders on a bunch of houses that I sold on wrap mortgages. I'll be dead before they don't get their money, because if I can come back if I keep my reputation. If I lose my reputation,
Correct.
I can't. It's going to be hell to come back. You know what I mean?
This is the long game, no matter how you slice it.
Yeah, it's the long game. I mean, I'd rather lose my money than lose someone else's money, because you know what I mean? I don't want to lose
100%.
anybody else's money.
100%.
How do you suggest getting in? Say, like, I don't have any storages. You know, I've had a reason. Let's just say I've had a reasonable amount of success. I have a decent amount of money in the account, but you know, I'm not wealthy by any means. How do you suggest I start in the storage business?
Yeah. So a couple of ways. And one of the ways that many of our folks that come through our doors have kind of surprised me as to how they approach and look at getting into the business. And that, you know, we've been teaching people for, you know, we were investing maybe 3 or 4 years before we started holding these little workshops at our Central Indiana Real Estate Investor Association that I was the president of. And, you know, going through the steps and making sure that everybody's covered. And again, the gotchas, you know, they don't know what they don't know. You know, we've been teaching people how to make sure they cover their bases. It's, you know, real estate is math, you know, and it's all in the numbers. And most of this is a math equation. So you got to get really good at underwriting and understanding the numbers. And in storage, as you know, Mitch, it's equally, if not more important, to look at the market. And you need to understand how to read and do an analysis on the market as well, because just because you find a facility that's struggling and it's at 50% occupancy, it doesn't mean you can take it up at 90 to 90%. If you look around and the other 6 facilities that are within 3 miles, they're all at 50%. Well, guess what? You know, that's a market problem. And it doesn't matter how hard you work, you're not going to be able to solve that. So you've got to understand the numbers, and you got to understand the markets as well. So there has to be a base level of understanding of the business itself. You know, keeping your credit clean, doing the things that you just mentioned, and creating relationships with bankers, and then beginning to assemble a team, as well as some capital, so that when you either find a deal or a deal finds you, that you have the ability to pull the trigger, because it is more intricate. There's more pieces to it. And if you don't have at least a base level of team members in place and the folks that are needed to get a deal across the finish line, you'll fall out of contract before that happens. But even before that, it's helpful to find not only a mentor, but a partner. And you can partner with somebody who's experienced, that you can bring into the deal or cut them in on a small part, that they can, you know, you can utilize a portion of their team and their expertise and their Rolodex, you know, to get this deal across the finish line, so that you can do the next one all on your own. Also, a different variation of that is, you know, we've had folks that have come through our self-storage academies to learn about the business. But then come to find out, they didn't want to learn about it to do it actively, or maybe they thought that was the case when they came in, and then they realized, there's a lot of moving parts to this, and there's a little more risk in carrying that much more debt. And if I buy an existing facility that is, you know, at 10% occupancy, or a development opportunity, that, you know, the lease up risk is something that I may not want to take on as well. You know, so development risk, lease up risk, and then, you know, signing on the note for all that. I think I'd rather be a passive investor and let Scott or let Mitch, you know, take on the debt and do all the lifting, and I'll be an equity partner and come in as a limited partner. And I just get all the benefits of that, and a K1 for depreciation at the end. And then maybe if I want to go do my own someday, you know, I have that baseline knowledge. I'm in it. I've got the experience. And so now I'm recognized by bankers and some private equity partners that I want to bring in as being somebody who has experience in the storage business. So, you know, in the beginning, it's learning. Don't buy enough more you can chew. Find a mentor, find a partner in the beginning, or be a limited partner, a passive investor, are some of the great ways to go along for the ride and earn while you learn, before it comes time to go do one 100% on your own. Does that make sense?
Yes. And one of the key things I was looking at in some of the notes for this podcast was, and it's the same in every business, the upfront due diligence is do or die. I mean, if you get that wrong from the beginning, you really have hurt yourself. You may not even be able to recover, depending on how wrong you get it. Then, you know, sometimes when you have big enough margins, or you're in a place where the market's just that good, or you bought the land that much undervalued, you have some cushion. I just built a $2.8 million place. It's 283 units. Okay. Brand new out of the ground. It kicked my ass. I'm telling you, it kicked. I chose to be the general along with my partner. And that was the worst mistake I ever made. And I subbed everything out individually to the locals around here. When looking back, I should have hired a company that specializes in building mini storages and paid the general contractor. whatever they, what they asked, within reason. And I would have been so much better off